Pramod Gubbi joins us. And Pramod, who is buying FMCG stocks? I can guarantee you that not 8 on 10 but 10 on 10 research brokerages would agree with me when I say that consumer staples are expensive.
Yeah, absolutely. I mean, I think I just heard your spiel now. I think I would totally agree with you. This has little to do with fundamentals. It's pretty much scratching your head and thinking, look, I've got some inflows in, what do I do with it? Look around for areas which have been left out in the recent past and reallocate. The initial bit of the liquidity inflow went into your own favorite stocks, but I think most people realize that redeployment into a select few stocks has meant that those stocks are trading at fairly stratospheric valuations, and you yourself can't justify those anymore, and as a result you're on the lookout for things that have been left out and start deploying there. So it's really hard to make out any logical sense here. I know we had one of the FMCG companies reporting strong numbers yesterday, but then if you read between the lines, it wasn't particularly earth-shattering. So yes, it's largely liquidity. It'll be pointless to make much sense out of it.
And Pramod, hi, morning. While we're rejoicing that the market is almost at the 9,400 mark, it's also time perhaps to tread with a little bit caution. And we just had that big debate on mutual funds and whether or not it's time to actually close in on your small cap focused schemes or not. Would you say that maybe it's time to play a little cautious when it comes to the side market, the small caps, because whenever that pause button comes, that's bound to hit the broader markets harder? Or do you think there's enough headroom and nothing to worry about as of now?
Yeah, we've been cautious for way longer than what's coming out in the public domain now. But having said that, I would agree that small caps as an asset class, yes, perhaps have done a bit too much, but they've always been a favorite hunting ground for bottom-up investors. So maybe not at the broader small cap index level, but I think if you have the patience and the diligence to sort of investigate opportunities in that segment, that will always be an area for alpha generation. Same with the large and mid caps as well. I don't think it's any different there for a bottom-up investor. At the broader index level, each of these asset classes perhaps are looking frothy as far as valuations are concerned.
So Pramod, if a client calls up and says, look, I've got inflows and I need to buy something, you would say, look, don't buy, we are bearish, sit on the cash. You cannot do that. I'm sure you'll have to give him some advice, right?
Yeah, I mean, look, I won't totally envy my client's position, so it's not the easiest time to be in. You clearly get a sense that that the current fundamentals do not justify the extent of the rally. So you either take a call that, look, I'm looking beyond the next 2-3 years, because there are underlying changes in the economy, there are structural reforms in place, which is making the economy more efficient. Clearly that's going to generate a lot of gains for some companies in the sector from a longer term perspective. So either you make that call that, look, I'm looking beyond the next 2-3 years earnings and playing the structural story, or increase your cash holding to the extent that it allows. But I can understand where you're coming from, because most people are already at that margin. To that extent, you will have to find avenues which haven't really display the same sort of euphoria in terms of valuations or stock prices. So I'm looking at sort of non-domestic focused sectors which have been neglected, particularly IT and pharma, where again it's not a broader call on the sector, but maybe select companies in those sectors where you believe that the investments in the last 2 years will bear fruit over the next 12 to 24 months, and make selective bets there. I heard you talk about real estate as well. That's been one sector where I've been hearing green shoots of recovery. It is a late cycle sector in some ways, where it can get propelled on a virtuous spiral upwards. Now with RERA in place, you could expect some sort of consumer confidence coming back into the sector. We've seen a period where prices have either sort of time consolidated or corrected in some segments. Interest rates are attractive. We've seen several developers refinancing their debt. We've seen one QIP so far. Perhaps we'll see a few more down the line. So if you see balance sheets getting strengthened in a much more conducive environment as far as regulation is concerned, which can instill confidence in consumers, that can be the next leg of growth. Early days still, but I think that's one sector perhaps worth watching out for. Metals, again, I know we've had a great rally over the last 12 to 18 months, but we've seen some sort of a correction in commodity prices driven by what's happening in China in the last 2 months. And every time we see this sort of a correction driven by China, you see that the Chinese are back to the old practices on lending, and you see the commodities are back up again. So I'll watch that space again. In case this remains a temporary scare, there might be a revival in that sector as well. So yes, it's hard to comb through, but there are a few opportunities if you really want to at the limit in terms of your cash levels and have to deploy it.
So when we interacted with Saurabh last, he told us about a theme, which is that don't buy lenders, buy companies which are in the insurance sector or in the AMC business. You've liked Motilal Oswal financials for a while now. Edelweiss is something which has done very well. Are you still hot on some of these companies which started as brokerages and now have expanded their wings and they've become complete financial superhouses?
I think we will still look at a more intermediary sort of a business where you are playing the role of a distributor or an asset manager or an insurance manufacturer rather than a lender. Lender, of course, is an intermediary as well, but it brings in question marks about the quality of lending, and hence it becomes a far more cyclical as opposed to a structural story. So to that extent, you have to make a call on the quality of the loan book rather than just the structural story of this whole physical savings shifting to financial savings, and as a result, as a role that you play as an intermediary, you tend to benefit from that structural shift. So we're positive on companies which are largely asset light and remain focused on this intermediation. Yes, valuations are looking frothy as well, but given the structural nature of this theme, we'd be happy to look through the next 2-3 years and continue to play it.
So Pramod, if you have to talk about a sector where you think the margin of safety is still strong, or you think more than margin of safety, the earnings recovery is around the corner and markets now are not anticipating it. Money, Pramod, let's say, is not made by chasing something popular. I mean, if an asset class is popular, it will not leave any gains on the table. So where do you think markets currently either are too bearish or they are not able to spot that trend?
I think like you said, liquidity is forcing people to hunt for those left out areas and laggards, and as a result, everything seems to be catching up. But having said that, relatively speaking, I think IT and pharma still tend to be ignored, given the ongoing problems. It's not like the problems are not real. There are real problems here, but that's where the opportunity is when the market tends to overreact on the bearish side, and that allows that margin of safety to begin. I'm not saying that there is an earnings recovery around the corner. The risks are real. The protectionist issues for IT, currency headwind, maybe the currency perhaps topped out, and that could be a tailwind for IT earnings to recover. But the more structural thing to look out for in IT remains the Indian IT companies to deal with this disruption around automation and digital technologies, which we know some of the Indian IT companies are investing heavily, and at some stage that will have to bear fruit. So that's one thing to look out for. In pharma, it's a slightly different concern. I think there is enough visibility in terms of drug pipeline. America needs a lot of cheap drugs. the Indian companies are capable, but yes, before the Americans allow you to grow your business there, they want to ensure that there is an element of quality maintained, and for that we need to see through many of these regulatory issues behind us. Some of them are perhaps ahead of most of those concerns. So you could be selective there and play again. But this is one sector where it has been ignored, but yet visibility of growth is much better, unlike IT. So I guess those two would be one, the two were worth looking for.